Hello everyone, it's been a couple months since the last time I made a video. I've missed a lot of absurdity and there's a lot to talk about. The main event is of course the S&P 500 declining over 21% from peak to trough and now already reversing about half of that move point-wise. The first trading ideology thing I'll talk about is with the yen and bearish positioning that doesn't necessarily involve hedging strictly with put options, where I've talked about prior to when I left about going long the yen and long stocks in unison because that was, in my opinion, a poor correlation, and you've seen it work really well over the last week or two, where stocks are roughly flat across this period and the yen is up significantly. And obviously, if you put this on after the massive drop, you would have won on both positions while being largely hedged across each day's move. And it's always something to look for. The best hedge is one that you don't have to pay premium for, and also one that can work even if the market continues higher, something like a currency position or yield position, where if you're right in your macro predictions, you can win twice, and if the market crashes, you're quite likely to be hedged as well. Obviously, it's not a perfect thing. If the market crashes, it's not a guaranteed protector, but many situations arise where stocks going down is the wrong part of a correlation with something else in the world, and it is very often something to look for. Also pretty happy about my last post on here before I departed, because it aged pretty well, though perhaps for the wrong reasons. I didn't exactly predict the great tariff scandal. However, lots of high-flying stocks that I mentioned here and cryptos have gotten absolutely throttled, as we all knew would happen. I hope we all knew that would happen. It was very obvious, in my opinion, though obviously it doesn't matter unless you're betting on it. I didn't exactly put on Shiba Inu shorts, but my mental short works and that feels good in the back of my mind, I suppose. There's also been some remarkable moves in gold, and as we said a moment ago, the yen. As of right now, my main sight is on soybeans and grains in general. I think they could all do well going forward. I'll explain some thoughts in a moment. Soybeans, this is obviously quite a remarkable chart, just moving over the 200-day moving average, getting into a potential uptrend. Spreads aren't super constructive yet, though it's relatively low in terms of prices historically, so spreads wouldn't necessarily be too backward yet, but at least you're not paying a lot to be long, so I would say that's rather constructive. And currently we're seeing it 2 down days off of a high close. If it starts to move up again, that would be a great sign. Anything further to the downside, I would hope to be able to get out at a break even or around there and not sit in too long, as we haven't exactly broken out into an uptrend, at least until we're about 20 or so points higher. The same is true for corn, though the reason I would prefer corn to soybeans here is that corn spreads are much more constructive than soybean spreads are currently, though soybean spreads are certainly catching up. I would like to see, in an ideal world, both of them start to break up and we can get some real backwardation and signs of uptrend. For now, we're in the early stages of what might be a great trade, but is far from anything inducing full confidence. As for equities, I haven't put too much thought into them recently. It's been very volatile and very hard to read and very news driven. And when markets are news driven, they can tell you a lot based on how things react to news, but in the time, it's often hard to trade. So I think what we've seen a lot recently is they've continued to pour bad news on it of uncertainty and doubt. And for the most part, we've rallied back a lot of the entire move at this point. And I would view that as longer term very constructive. I still believe the AI megatrend is in full effect and that is the main driver of markets for the next decade. So if this turns into a whole instance of a massive set of bad news and tariffs and global uncertainty not being able to tear us down and we end up on all-time highs in even a few months, let's say, you have to be prepared to buy that even if you think it's stupid. That's my view. Though for now, until then, we're in very shaky waters, and I imagine there'll be a moment of chop before there's a new move decided. But given the potential for a snapback rally that people don't really expect, and that option prices have now declined moderately, this is a position I view reasonable. Shorting the weakest index on the rally, which has been the Dow, and buying some out-of-the-money calls in the S&P in case we just get a face ripper back to all-time highs after Trump sort of throws in the towel on every bit he's put in so far, and the market believes him. I think there's definitely a possibility of that. And I think if we end up recovering the pre-tariff levels rather quickly, the chance that we squeeze reasonably higher becomes quite likely in my opinion. But I continue to find equity-related trades the hardest money to make right now, so it is where I'm the least focused. Though I'm, in general, less equity-brained than everything else, so I'm sure there are very many individual stock opportunities. I tend to not look for those a great deal. It's just not my bread and butter. So here's a back-adjusted chart of wheat. This is something that I think is really interesting, and I don't necessarily believe things have to right course right now, but for some reason this reminds me of cotton in 2010, around there, where there has been so much contango for so long that people take it for granted as if it's a certainty that wheat production is always going to be so good, and they're getting very confident now, in my opinion. First off, here's the cotton move I'm saying it potentially reminds me of, where you had a ton of contango, where spreads were incredibly forgiving for a long period of time, and things sort of just stopped happening in that sense, and you got a big squeeze in around 2011. I think perhaps wheat could be on a similar trajectory, and I'll show you the position I think is the most reasonable to take here, where you're not necessarily going directly long this chart, because this isn't a chart that you want to go long. The wheat curve is still terrible, but the bet here, in my opinion, is that this is pretty maxed out, and rather than simply going long any of the individual contracts, we'll go long Z25 against, say, July 26, and you'll just bet on that spread differential. And here's what the chart of this looks like. It's not really close to maximum carry. I think that's around 50 or so, but it's quite close to maximum carry, and given that the harvest for this year's wheat hasn't yet taken place, there's a lot that can still go wrong, especially before December, to where this spread being so forgiving seems like a potentially massive mistake if really anything is going to happen. And so for at least the next 2 months, I can't imagine this goes much lower, but there is a real chance that it goes a lot higher. For instance, here's this same DEES July spread up until the end of 2021, where for the most part it was flat or even positive, up to 50 points in the positive, where now it's minus 35. So they're pricing in perfection in wheat production, obviously, and if anything less happens, there's a lot of potential upside in those spreads, and if what's being priced in does happen, there's not a great deal to lose in that bet, in my opinion, so it just seems very asymmetric to take this bet. Now, keep in mind that interest rates are a lot higher now than in 2021, and that is a significant part of the calculation for what is the maximum carry, but that's not enough to take it this far down, obviously, but it is something to keep in mind. But as I showed you earlier with the corn and soybean spreads, those are both positive, so for wheat to be so confident that nothing's going to happen seems like a potential mistake, though I would say the primary bets in grains should be, number 1 in soybeans, number 2 corn, number 3 wheat. But the bet in wheat obviously is simply the asymmetry of the spreads and not necessarily wheat playing a leading role in a rally, just that if grains as a whole rally, this spread could reasonably go up the most, because it is perhaps the most confidently mispriced. Now, the last thing I'd like to touch on before I leave is the VIX, which for many, many months at this point I have been saying not to short, and I continue to say this. I will perhaps make a longer form video about this whole topic, but I've said that shorting the VIX has been the worst long equity position this entire time through, and I was proven right the entire time, and on the rally, it's pretty much the only opinion I had over the last few months where I was far less market focused, because the VIX was going 30, 40, 50, and people were shorting the front month contract still in the 20s or low 30s at that point. So if the VIX is at 50, why would you go and pay to short it at 35 when there's a very real chance the VIX ends up going higher? And if you believe the market is going to rally, at that point just buy the market, because the VIX could very reasonably remain elevated and stocks also rally, and then you lose when you were right. And you don't want to set yourself up in a situation where you are right and you lose money. The time to short the VIX isn't on a massive VIX spike where you don't know the top is. It's never the time to short the VIX. The time to short the VIX is in, say, 2022, where, say, the VIX is in its 20s or 30s, and VIX futures are far above that, where you're getting paid to short the VIX. It makes a lot more sense to sell the the pink line here, when it's far above the VIX, when it's, about at this price, then go and short May VIX when the VIX is at 40 or 50, or over here even when the VIX started to get above it. It was just a bad idea. And even now, they're pricing the May VIX at 23. They're still pricing it below spot price. It's not the time to be selling volatility. The market could very easily go up and volatility get killed, but if you just go along the market, you're going to realize that position anyway. So there's no sense going short the VIX when your position is just that the market's going to go higher. You want to sell the VIX when you want to sell the VIX and you think that the market's going to do nothing or the VIX contracts are overpriced. Right now, that really isn't the case, like you saw towards the latter end of 2022 or in 2022 as a whole. Selling the VIX was great throughout that entire period, and it outperformed equities that entire time. We are not yet in that environment, and we might not be for a time. At least in my opinion, it's still just not the right trade at all. Because in general, volatility has a premium to the upside, so you are paying to sell it below spot price, and if anything does happen to the market and the VIX has to rally, you've shorted it below its current price. Everyone understands this, and the market obviously implies this mean reversion, which is the cause of this discrepancy. So you're paying to be on the wrong end of that trade, in my opinion. It really just makes the least amount of sense to me, especially at these prices, where if they were offering it to you 3 points, 5 points above spot, maybe you'd like to do that. But for me, at these prices, it's still just not the right trade to put on at all. And it has been that way for, I would say, a year now, but more potently over the last 2 months, as I've expressed, hopefully convincingly. But there's not too much to talk about aside from those things. I imagine I'll make a video on other aspects of when to short the VIX and such at some point soon. Otherwise, I'm back, I'm here, I'm ready to trade some markets again. I hope you enjoyed, and I'll see you next time. If you haven't already and you're still watching to this point, consider subscribing.